after the global financial crisis, everything dried up. So Congress, in one of the only and probably one of the most impactful bipartisan acts of Congress during the Obama administration, was the Jobs Act. And they said, well, look, now the market has collapsed, right? Values have gone off a cliff. People have been kicked out of their homes. The banks are not lending. There's no cash in the economy. We need to do something.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Ballara, and this is the Know Your Why podcast. Today I'm here with Dr. Adam Gower. Dr. Gower is a 30-plus year real estate veteran with over $1.5 billion in real estate, commercial real estate investment and finance experience. Today he builds digital marketing systems for real estate professionals who want to raise capital online. So Dr. Gower, I'm gonna stop there. First, I just want to say thank you. Thank you for taking the time out for coming on the show today. And I just want to let you kind of tell your story, tell your background. I think probably it didn't start with $1.5 billion of commercial real estate, so there's probably something leading up to that.
Yeah, that's a commercial real estate experience, by the way. And you know, it's funny because you said Know Your Why podcast. I actually thought you said Know Your Wife podcast. I thought, oh, well, that's a whole different theme. Wasn't sure what that was going to be about. Right. So what's your first question, Jason? Sorry, where do you want
First question is just tell us about your background. Tell us how you got started, your PhD. I'm guessing it's not in real estate. Maybe it is, maybe I'm wrong about that. But maybe tell us your background and kind of, you know, your journey into and through real estate.
Sure. So my pathway to real estate started in, apart from family stuff when I was growing up, but apart from that, started in Southern California. And I used to, so it shows how long ago it was, I hope, early 1980s. I'm just going to adjust my camera slightly. Early 1980s, I used to, seriously, I used to knock on doors in the neighborhood I was living in. And I would say to people, I'll do anything for $5 an hour. You know, some people would go, anything? Well, within reason. And one of the guys that whose house I knocked on, whose door I knocked on, said, yeah, will you dig a trench for me? So I said, yeah, I'll dig a trench. Anything for $5 an hour, it's fine. It turned out he was an electrician. And so I did a good job of this trench, apparently. And so he asked me to help him pull wires, which was, you know, hard labor as well in a very different kind of way. So he used to send me up in attics and crawl spaces and, you know, fight with dead rats and sometimes live rats and spiders and dust and God knows what else. Anyway, so that's how I started. That was really really literally getting my hands dirty at the ground level, if anything, if nothing else. But then very quickly, I started to raise capital for a sponsor, a ground-up sponsor. He was a family friend, and they did ground-up multifamily deals, and they wanted to raise capital. And short story is, I had good connections with a Japanese shop in mergers and acquisition shop, and through them started to raise capital for ground up multifamily. So that's really where it started a long time ago.
So you really did start, but like right in real estate. And it's funny you mentioned the trench digging and pulling wires. I did the same thing. I just wasn't smart enough to move into raising capital and doing multifamily quickly after that. I did a lot of working with contractors and being in those attics and under houses and things. So you started there. So we're still talking about the 80s, maybe 90s when this was happening. Obviously, a very different. Well, the rules were different. Capital raising, the rules were different then, but also the technology, the sort of ability to reach a wide audience was different then. What were you doing? How did you get started? Because I would imagine that those skills and processes apply regardless of time or technology in terms of being able to develop that skill.
Right. So I'm taking notes while we talk. So if you hear me tapping around a computer, that's what I'm doing. So we did have high tech in those days, actually. We had FedEx. If you want to get it there, what was it? If you want it there tomorrow morning, absolutely positively want it there tomorrow morning, something like that, FedEx. And that was the technology that we used. It was miraculous. This was, I don't know, gosh, was it even pre-fax? No, it wasn't pre-fax. I'm glad to say it wasn't pre-fax. But even faxes were new. It was all heat generated. I don't know, it was some kind of paper that it wasn't printed. It was somehow burned onto a piece of heat-sensitive paper or something. It was really old school.
The paper came on rolls, I remember.
And we didn't, it came on rolls. And we didn't have, there were no cell phones. It was pre-cell phones. Mm-hmm. The first cell phones did kick out. They were these huge brick things that you carried around, mostly magnets, not magnets, batteries that had a phone with a curly wire on it that we'd walk around with. Those were kind of cool.
Yep.
And the rules were definitely different. You couldn't advertise. I mean, there was obviously no internet, there was no email, but there was direct mail, so you could send out, 1 million letters if you wanted to, but you couldn't do that for raising capital. It was prohibited. Nobody thought about doing it that way. So everything was through networking, private networking. And again, I forgot your question, and I go down these rabbit holes. Jason, what you asked me.
No, I mean, you were sort of answering the question. Kind of what were you doing? What did you do then to start these equity raises? What were your initial steps? How did you approach people, and then really kind of how has that evolved over time?
Well, so when I started, the only way to raise capital was to network and in person. So quite literally join a country club, or you would go to a conference or a trade show and exchange business cards. I had some relationships with Japanese investors. That's a whole long story, but that was through some mergers. I had actually originally wanted to get involved in venture capital. Okay. And so I wrote to all the venture capital funds in California, and one of them happened to be a little Japanese M&A shop. And I used to have breakfast with this sponsor. Once in a while. He was a family friend, and he was telling me the kind of returns and how they make money. And I just thought, oh my goodness, that's amazing how you do that. So much easier than M&A. Why are we running around looking for these little businesses to buy? And so I introduced the idea of investing in real estate to this Japanese company I was working with. And it just took off. I mean, there was a huge momentum. There was a lot of Japanese investment in US real estate in the 1980s, late 1980s. And so really this was just part of that wave. And the way that it worked was that literally people would fly in, sit around conference room tables. And my job was, I was the guy that for whatever reason seemed to be thought to be good at it. I was very young, right, early 20s. I would stand in these conference rooms and work through a set of slides, pitching these ground up deals and how they worked economically. And I had clearly had a natural knack for it, apparently one that was better than other people. I mean, it's the only way I can explain it. What can I tell you? Yeah. I mean, I was brought into a world of of seasoned real estate professionals who had been doing this for all their careers. And I was a young lad, and for whatever reason, they thought I was the best person to put in front of high net worth individuals. So that was what I did. And it was all manual. I used to produce documents. I remember printing documents, pitch decks, on color printers or whatever. I don't remember if they were color or not. But I remember having huge stacks of these. You print one page and then another page and then another page. And then I'd walk around a table and I build these things one at a time. Page one, all right, do 20 of those. And then I'd grab page two and I'd walk around the table and lay those on top of page one, and etc., or the other way around. And then we had these binder things. We even bought a binder machine. We'd bind the thing, put on I forget what they called it. Somewhere I've still got the thing in a bloody thing somewhere over there. Yeah. And we'd produce them and hand them out. I mean, that's what we did. It seemed like it was efficient because we were able to do a dozen at a time, or 20 at a time and hand them out and then present to a bunch of people. But it was, of course, incredibly inefficient because every time, and wasn't just us, it was the way regulations required it. Every time we met somebody, we had to go through the same process of explaining everything from the very, very beginning: who we are, what's multifamily, how does it work, what's your track record, etc., and then pitch a deal. So now, of course, the world has changed. And what we do now, this is what my company does. We build crowdfunding platforms for sponsors. So in principle, nothing's really changed. We still produce pitch decks. We still educate prospects on, background of our clients, by the way. We don't do this for ourselves. At least we haven't done yet. We will be doing, but for the time being, just for clients. You put everything about a client's background and track record and experience and investment philosophy. It all goes on a website in considerable detail, and it's not pitch stuff, right? It's educational. What is the IRR, and why do we see the IRR through this lens? Why is our perspective of cap rates this, etc.? And so all that goes onto a website. And now, instead of handing out flyers or manually talking to somebody, again and again and again, one sends a link to a website or to a page that has information, or to a case study, or to a white paper. And that way, it is possible to communicate. I like to think of it this way. This way, now you can communicate with everybody, everywhere, all the time. Yeah. So what we now do is push all of this information out to from website. First, we create educational materials for our clients, and then we push it out onto social media, either paid or unpaid. And then prospects discover my clients and navigate to their websites, and they're able to learn about them in their own time, on their own devices. There's no need to meet and to sit in a pitch meeting and to travel somewhere to see something. It can all be done remotely, and from an investor's point of view, anonymously. Oh my goodness, how nice is that? You can actually research a sponsor and their background without ever having any communication with them, and you can decide for yourself whether or not this is somebody you trust enough to invest with. And then once you get to that point, then you can engage them if you want to. Even then, you don't have to. We have clients who raise money from people they never speak to, never email with, not anything other than automated emails, and never have any kind of direct communication with. It's all automated and remote, and quite, fantastic for everybody concerned.
Yeah. I mean, the technology now just makes it so much easier. I'm sure probably anyone under 30 has no idea what you're talking about with those binders and stacking the papers around the table, but I've done it, so I know exactly what you mean. But
FedEx, you remember that?
Right? Yeah. Oh yeah, FedEx.
What
FedEx.
was
There,
that?
there was no Amazon, that's for sure. It
No.
was all FedEx was the very, very best you could do. When you're talking about you're using the term crowdfunding, are you talking about like specifically Reg CF as far as raising capital, or you're talking about just the ability to use technology in the internet and things like that to raise capital?
Okay, so now you've asked a regulatory question, so I'm going to answer that. I'm going to make it brief though. But in the nanosecond that you were actually asking that question, I did look it up because I do need to know these things. FedEx advertising slogans this was what it was. When it absolutely positively has to be there overnight. And that was that was their slogan from 1978 to 1983. Oh my goodness. It's just, shows how old I am. Anyway, so that's what it was. Right. So okay. So there are two sides to crowdfunding. One is the legality and what you can do, and the other is the practical implementation of that. So, or practical application of that. So the laws changed, and the laws said, it used to say that you cannot solicit an investor. You cannot say to somebody, would you like to invest in my real estate deal? Unless you had a pre-existing relationship with them. You had to have a relationship, an established relationship of some sort, whatever that might mean, through business or because they're friends or family, but you had to know them. And that was a law that was laid down in 1933 Securities Act. You had to know them. And so what that did was it restricted real estate sponsors from advertising. You can't advertise. You couldn't put an ad in the paper that said, invest in my deal, because that was essentially you were selling stock. That's what you're doing. You're selling securities. Right. And it was illegal to do that because people other than those that you already knew would see that. So you couldn't do it. It was illegal. Couldn't advertise. And by advertising, that's paid and unpaid. So you couldn't go to a conference where you were being paid or being a guest speaker somewhere and say, hey, I've got this deal at the corner of Walk and Crosswalk in front of an audience. That was also prohibited. So the concept of advertising is everything, every form of communication, paid and unpaid, where you are in any way at all broadcasting your message to people you don't already know. In 2012, the laws changed and said, okay, now you can advertise. So because this is now the digital era, what that meant was you can have a website that says invest with me. You can advertise on Facebook. You can go on podcasts. All bets are off. You can go to conferences and say, here, I'm here to pitch my deal. Here, invest with me. So suddenly now you can advertise. But hey, guess what? Now the laws have changed and say you can use digital marketing to raise money for your deal. Well, how do you do that? How do you actually do that? Oh, and by the way, you asked about regulations. So specifically, the regulations are Regulation CF, Regulation Crowdfunding. That's a whole different thing. It is a minuscule part of how capital is raised. It has to go through a funding portal. I'm just going to throw out these technicalities at you because we need to get past them quickly. It's not really relevant, but you can raise money using a Reg CF. You've got to go to a crowdfunding portal, a funding portal like smallchange.com or smallchange.co, and it's highly regulated, tough to do, very limited, and it's actually just very difficult to do. But you can raise money from non-accredited investors as well as accredited. Regulation A+ also was legalized or came into law in after the Jobs Act, and that also allows you to solicit from non-accredited investors. That is called a mini IPO. So think of an IPO. It is regulated. You've got to do a load of disclosures. There are all kinds of regulations for what you can have on your marketing materials. Also, though, a very, very small part of what changed with the Jobs Act, what has come to be called colloquially crowdfunding, really is just syndication online, syndicating a deal online. But the really big one was Regulation D506C. And that's the one that allows you to solicit from any accredited investor anywhere. In other words, you can advertise. That's the one that is by a massive margin, the one that is most commonly used to raise money for real estate. But the difference, so those are the regulations. Now suddenly you are able to advertise. But how do you do that? Like, nobody's ever done it before in real estate. Just about every other industry in the world uses digital marketing one way or another, especially big ticket items, right? I mean, you want to buy a car and run a search, you're going to see a gazillion hits for how to buy a car, right? But you never were able to do that for real estate. So the mechanism of how you implement those regulatory changes are essentially founded in digital marketing. All the tactics and techniques and strategies that you would, and technology that you would apply for any kind of digital marketing for the first time could be applied to commercial real estate capital formation. That's what we do.
Okay. Yeah, thank you for the explanation. I just wanted to, I felt like I knew what you were saying, but I just wanted to make sure we weren't talking about
Did
regulation
I clarify
CF
that
here.
all right?
Yeah.
No,
that was perfect. That was perfect.
Yeah, Reg CF is not what I'm talking about.
Perfect. So I mean, the changes, it's interesting. I don't know why this never occurred to me before, but if this all changed in 2012, that was after the Great Recession, right? We had already gone through that. And, so I think that I never connected that timing of that before, but was that somehow related, do you think, or just?
Oh, what a nice question. Yes. So actually the history is like this. So it's actually all in my book, Leaders of the Crowd. He said, plugging away here. This was published by Palgrave Macmillan, and I interviewed people in the White House and in Congress and lobbyists and early adopters of this whole new set of regulations. And this is what I discovered. So the 1929 Great Depression. The Great Depression, oversimplifying it to the nth degree, was largely driven by an excess of liquidity and loose standards on who could be solicited to invest in stocks. So, and you could borrow money, and there was just like this whole too much liquidity, essentially, and too few regulations protecting investors. And then there was a depression, the stock market collapsed, and we all know what happened after that. In 1933, Congress decided we need to limit limit liquidity in the market. And so they passed the 1933 Securities Act, and the Securities Act put limitations on, I've already talked about this, put limitations on how you could solicit investors. And what they said was, the Securities Act of 1933 said, you cannot solicit, well, actually what it said was, if you want to raise money from the general public, essentially, simply speaking, you have to do an IPO. Well, no real estate shop is going to do an IPO. How do you do an IPO? Facebook do IPOs. Even in 1933, it was a huge ordeal to do an IPO. So little real estate guys, right, or gals out there trying to raise money for a deal at the corner of Walk and Crosswalk, they're not going to do that. But there was an exemption. The exemption is what I've talked about. The exemption said, all right, you don't have to do an IPO as long as you only raise money from people you already know. That was the exemption. So the story there is, first of all, two things. First of all, it was the 1933 Securities Act was designed to take liquidity out of the market, or put restrictions on liquidity. And something else happened that I've forgotten. It restricted how you could solicit, right? Mm-hmm. So that's what happened. And that was a result of too much liquidity. Oh, but that's what I was going to say. An unintended consequence. So the Securities Act was never intended for real estate of 1933. It was never intended. It was all about businesses and how businesses raise money on the stock market. So it was an unintended consequence that real estate got hammered by this as well. And suddenly now you go into these darkened, smoke-filled rooms, but with wealthy people sitting around in golf clubs, wheeling and dealing together, right? So that's this kind of cliche, the golf club, country club cliche.
Yeah.
2012, what happened? The great financial crisis, the GFC, massive liquidity in the market, too much liquidity, too much money in the market, banks with loose lending standards, people borrowing with no credit, no ability to pay it back, too much liquidity. But then the global financial crisis, what happened was that everything dried up. And suddenly there was a lock in capital in the markets. Banks stopped lending. Investors stopped investing. There was no liquidity. Suddenly, after the global financial crisis, everything dried up. So Congress, in one of the only and probably one of the most impactful bipartisan acts of Congress during the Obama administration, was the Jobs Act. And they said, well, look, now the market has collapsed. Right, values have gone off a cliff. People have been kicked out of their homes. The banks are not lending. There's no cash in the economy. We need to do something to get liquidity back in the market. And so they looked back at 1933 and they decided, well, one of the problems is that small companies are unable to raise capital. They're restricted by a small startup can't do an IPO. Facebook can do IPOs. A startup cannot. And so they have no access to cash. And that is what was preventing the economy from coming out of this incredible Great Recession, otherwise known as the global financial crisis. So the Jobs Act was passed, the Jumpstart Our Business Startups Act. And the Jobs Act, right, clearly by its name, was geared to bringing liquidity back to small companies. Oh my goodness. And an unintended consequence of that, again, was real estate. Real estate, no one ever thought about real estate. And I know this because I spoke to everybody that was involved. They never thought real estate was a factor. They wanted to bring liquidity back to small companies after the after the Great Recession, right? When there was no money moving around, how do these little companies grow? They can't get money from the banks. There's no equity. They need to be able to advertise. So the Jobs Act was passed. That allowed for quote unquote crowdfunding. Technically, it allowed for them to advertise, to sell shares in their companies so they could raise money without doing an IPO. And guess what? Every single real estate deal involves the first thing you do, you find a building at the corner of Walk and Crosswalk, and then you go out and you form a company, a limited partnership, an LLC, whatever it is. And to raise money, you sell shares in that company. You solicit shares. That is a securities regulator. You under securities regulations when you do that, and therefore fall under the Jobs Act. So for the second time, real estate was an unintended consequence of an act of Congress.
Fascinating.
Long answers to short questions.
No, that was great. That was a great history lesson, like how it all ties together too. It's just yeah. I won't get into the foulings of government, but this seems like a fairly big miss it just not noticing real estate, I guess, in making
no, it wasn't intended for real estate.
Yeah,
it just wasn't intended in either cases. It just was an accident of it. And in fact, real estate has been probably the greatest beneficiary of these regulations as a result.
Yeah.
But if you're not in real estate, then who thinks about it? I mean, do you think about startups or venture capital? I don't know, maybe you do, but most people in real estate, they only myopically see the world of real estate.
Yeah.
And if you're not involved in, I mean, I still talk to people. Seriously, Jason, it blows my mind. I went in for whatever, I met a doctor recently. And he said, well, what do you do for a living? I said, real estate crowdfunding. He said, well, what's that? And I just thought, oh my goodness, there's still people out there who don't know really actually anything at all about it, and what's involved and how you can actually invest in real estate. It's mind-blowing to me. But when you're in your own little bubble and your own little echo chamber, it's all you ever hear about, right? And you don't realize there's worlds outside, and it's kind of interesting when you discover them.
Yeah, it is. I mean, it's very true. I mean, so many people still don't know, even with all the digital marketing that real estate investors are doing and stuff. There's still a lot of people that just don't even know it exists. So it is a fascinating, I guess, disconnect there between like, people in real estate, people outside of real estate.
Well, that's why I have a job, you see, because my job is to help educate the masses.
To help make that happen.
That's always been my job. But anyway, your podcast is the Know Your Why. That's a really cool question, actually. So what's that all about?
Yeah, it's definitely, I mean, it's the premise for me is that people have, and this is because I sort of discovered my own, but people have a why or a reason behind their continuing to push for success. A lot of times at first it's you want to make some money if you didn't have money, but then you get sort of bigger and bigger reasons to keep going once you're in that comfort zone, or you don't keep going. And for whatever reason, it seems as in the real estate space, people definitely keep going. They just you reach high levels of success and then kind of go on. So I that's generally, I ask every guest, what is your why? What keeps you going? What keeps you sort of motivated, I guess. It's not easy every day.
Right. That is just such a huge question. And you've said a dozen things around that, each one of which could warrant hours of conversation. Life, liberty, and the pursuit of happiness is probably the greatest why that we all have. And even though it might be a bit cliched, what is liberty at the end of the day? I used to think, freedom. What is freedom? And I would walk down aisles when I was first at supermarket aisles when I was first in America, and just see, like, go try buying peanut butter, and to the supermarket, and there's 100 brands and every different possible combination of peanut butter or bread. How many types of bread? And how do you choose? So wouldn't it be nice if there was just one? And then you would have freedom from choice. It's one of the struggles that people have in life, finding a soulmate. It used to be like my grandparents they married because of arranged marriages. Their parents decided who they were going to marry. Yeah. What incredible freedom. You don't have to think about it. You're not chasing about, is she right? Is he right? This, she doesn't do that. I'm not sure about this. And people spend their whole lives like wondering, am I giving in? Am I giving up? Am I selling out? And you think, wouldn't it be nice if somebody said, you're going to marry her, end of story. Perfect. No, I don't have to think about it. Freedom from choice. Sounds ridiculous, but freedom, when you're in a world with infinite choices, almost, for how to live your life, that in itself is a burden on the psyche. How do you decide? How do you gain happiness if there are always choices to go further and further? It's one of the classic examples. So there's this book, now I'm on like this great soapbox now, but there are a few books that I've read. There's one of them, I'm trying to see if it's up here. I don't think it is. It's by Lord Layard, I forget here it is, Richard Layard. Happiness, Lessons from a New Science. And what's this? Richard Layard is actually a lord in England. Richard Layard, Happiness, Lessons from a New Science. He looks at studies, and he actually was an advisor to the British government, and he advised them on how to structure tax and how to tax the masses. And the idea was, this was Tony Blair's government, whatever, it doesn't matter who. But the idea was, how do we tax and spend in a way that maximizes the overall level of happiness in society, right? So this was kind of what underlay this research. And what Layard did was he looked at all the studies measuring happiness. And what he discovered was this contradiction, this contradiction that wealthier nations, so more money, that have longer lifespans, so better health, don't necessarily, in fact, in most cases, have lower levels of happiness overall by whatever measures than poorer nations with shorter lifespans. Okay, so he dug into, like, why is that? And he came up with this great example of why that is. And it was actually one of the less scientific studies, but it was a study, back of the envelope study conducted, I won't say at Harvard. It might have been one of the other Ivy League schools, but let's just say at Harvard. It goes like this. You've got two options. All right, Jason, two options. Option one, you earn $100,000 a year, and everybody else around you earns $75,000. All right, so you've got 33% or $25,000 more spending power than anyone else. That means you have the fanciest car, the greatest house, the biggest swimming pool, the nicest clothes than anybody else. That's option one. Option two, you earn 150,000. So now you've got 50% more buying power than option one. So even bigger car and a bigger house and a fancier holidays and vacations and fancier clothes and jewelry and everything. But everybody else earns 200,000. So they're even better off than you are on option two. Which would you prefer? And what he found was that most people go with option one. They want to have more. They would feel better about themselves if they had more than anybody else, even if it meant having less. And the reason for this is that we compare ourselves with our neighbors. If you're sitting there in your house, happy, oh, look, I've got this lovely house and I'm really comfortable, and your neighbor pulls up in a brand new Ferrari, Lamborghini, or what, a Lamborghini, whatever he pulls up in next door, you suddenly look at that and you think, I want one of them. Why has he got that and I don't? So now suddenly you go from being content and happy to miserable because you've not got the nice car or the golf club membership or the fancy vacations that your neighbor has. And so you end up in this cycle where all you're doing is compare. It's one of the hazards. Now I'm really going down a rabbit hole, nothing to do with real estate, but it's one of the hazards of social media. When did you ever go on to Face Chat and all your friends are saying, oh, woe is me. Life is such a struggle, right? I've got these bills to pay and I'm not earning enough and the mortgage is getting on. Nobody writes that. All they do is tell you how wonderful life is. And so you go onto social media and all you see is your neighbor next door having a better life than you, because that's all people post is the good stuff. And so it makes you feel miserable. So what is your why? I mean, one of the greatest answers to that question is, I don't know why, but how? How do you find happiness in what you've got? That's really the ultimate challenge, is just be happy with what you've got. That's how you find happiness. Yeah. So why? What is your why? I don't know. The pursuit of life, liberty, life, liberty, and the pursuit of happiness. Isn't that everybody's why ultimately? But how you get there is a totally different story.
Yeah. I mean, I've never heard that option study, I guess, with the two. I mean, but you're right. Yeah. Social media is a highlight reel. It's just, most people just posting the best parts so that they can, I guess, compare with everybody else. It is a funny, I guess, crowd psychology type of lesson to talk about and learn. I think it understanding those things probably help with your business and your ability to help develop, digital marketing and media strategies for people that are trying to reach the masses and appeal in such a way that it is going to reach as many as possible. I would think understanding these things feeds into that.
Well, yes, of course, because, unfortunately, marketing, human psychology has never changed, right? So this idea of wanting more than your neighbor is nothing new. It's what drives all marketing, and it always has. So, for example, the idea of FOMO, fear of missing out. These are psychological triggers that are used across all types of marketing, not just commercial real estate, capital formation, but everything, right? So invest in this deal and get these amazing returns by Friday, or you'll miss out, right? So, well, gosh, all these people with 400 investors already in, only 10 slots left. Well, why should they have all this good fortune and me not? Quick, let me make my investment. And so you end up with this emotional reaction to marketing instead of being rational and really digging into what's going on and being driven by it. But it happens all the time, right? I mean, it's what happens. This is how our capitalist world works, right? This is just how it works.
Yeah.
For better or for worse.
Yeah, I agree. And it's interesting. I was going to ask you, sort of how the history of regulation and things like that. One thing that always gets to me, it doesn't really get to me, I guess, in the sense, but I feel like it doesn't make sense. But when we look at the regulations behind the 506B and the 506C, where, we can advertise, but it's only for accredited investors. And essentially what gets me is the rules are based around accredited investors and who can invest where. But then you contrast that to the stock market, which is what most people have access to and know about, and there are no rules or regulations keeping them from kind of losing money there. Like what people say is we have these regulations and these private placement and real estate syndications because it is essentially to protect those investors, but those same protections aren't really present in traditional asset class of stocks. What is your take on that? Do you agree, disagree, have thoughts on sort of why it is that way?
I'm not entirely sure that I understood what you were saying, but basically, look, any kind of investment is a risk.
Right.
And anything in life is a risk. Getting in your car and driving down the road is a risk. In terms of investments, though, there's risks with everything. I mean, there's a balance between risk and reward. If you're looking at an investment that has an outsized reward, by definition, that also has an outside risk. You can invest in I don't know, you can invest with your bank. You get 5.5% now in bank deposits. That's risk-free, zero risk. So if you're wanting to get 6% or 7% or 10% or 15% or 20%, that's not risk-free. That is, the higher the projected return, the higher the likelihood that you will lose your money. Not just not get the projected return, that you will lose your capital. So and it doesn't matter in what. I see that I'm not a stock market. I have stocks and shares, but I never look at them. I have a financial advisor. He does it. He always likes to get together with me once every 6 months or 3 months or whatever, get on a big long call, tells me what he's doing, and then asks me yes or no. And I just always say yes. Why do we need to have these calls? I don't know. Whatever you just said, yes. Because I don't want to think about it. My brain doesn't have the capacity beyond the expertise that I have, which is in commercial real estate. But not sure why I went down that. Risk reward. But even with stocks, right? You can lose money. You might not lose everything, but you can lose. What can I say?
Yeah.
Diversification is the best option. Don't put all your eggs in one basket.
Absolutely. Completely agree with that. What is your take on investing in a downturn? People, whether you're speaking to active or passive investors, but something, that it's on a lot of people's mind right now. Your area of expertise is raising capital. What are you seeing right now? What do you think about, kind of the I guess thought process that investors should have right now?
All right. So the first thing I'm going to say is, Jason, I've got a hard stop coming up in a little bit. So this is a really good question to start winding up with.
Yeah.
So the best thing to do during a downturn right now, I'm going to date stamp your podcast. Sorry to do that.
That's totally fine.
Late August 2023. Right now, be patient. Don't rush in. There is a long way down yet to go. If you've ever been to the Grand Canyon, you will know that there are two ways of getting down to the bottom of the canyon. You could either jump off the edge, in which case you'll get there very, very quickly, but it'll be very painful when you land. Or you can take one of those really long, circuitous, kind of slightly flat paths that switch backs and forth all the way down. You'll still get to the bottom, but it'll take you longer and you won't hurt yourself quite as much. That is the economy we're in now. During the global financial crisis, boom, we went off the edge, flew down to the bottom and landed with a hard bump. This time we are cruising to the bottom very slowly and in a measured pace for a variety of reasons. What that means is don't rush in. If you buy something today, chances are you are doing what's called catching a falling sword or catching a falling knife. You might think you're getting a bargain, but that thing is still going down. So you're catching a falling knife. Don't do it. Be patient. There will be plenty of opportunities to invest in discounted, distressed real estate through Gower Crowd, my website, or through others as well. But don't rush into it. Don't familiarize yourself with what's going on. Get comfortable with some good sponsors or some people that you trust who have access to discounted distressed deals, and just wait patiently. Keep your money to one side and be patient and wait. The time will come, but it's not yet.
Great. Well, I know you have a hard stop. How can people reach out to you, or how can they find you after they hear this?
The best way to reach me is at gowercrowd.com. That's my last name, Gower, gowercrowd.com. And I have a weekly newsletter. It's free, and we cover all the latest updates and what's going on in commercial real estate and syndication, crowdfunding. It goes out every Wednesday. And as soon as you get one of those, if you want to ask me a question, hit the reply button, and I will be on the other end of that. Happy to answer any questions you might have.
Perfect. We'll put that in the show notes so people have it and they can find you. Dr. Gower, this was amazing. Thank you so much for your time. Thank you for the history lesson. Actually, I thought that was amazing. Kind of understanding, that the regulatory changes. So thank you so much for taking the time out today. I really appreciate it.
Jason, the pleasure was all mine. Thanks so much for your really, really interesting questions. Made it a pleasure to be here. Thank you.
Great. Folks listening, I know you're going to love this episode with Dr. Gower. Please like, rate, and review so we can get more great guests. And thank you all for listening.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.